Hi, and welcome to Finance Concepts by your finance-ista, Cynthia Bush. So let's focus on common stock. First, I want to show you a picture of an old common stock certificate. Companies used to laboriously create these. As you can see, the one from Walt Disney is particularly colorful. And then they would sell them to investors in return for cash. This piece of paper evidenced that the person holding it owned a share or a percentage of the company. Even today, while we're in a digital world, companies still create common stock certificates. Here's one for Amazon.com. But since we're in a digital world, these pieces of paper are no longer printed and handed to investors. Instead, everything is done over the computer. Let's take a look at common stock certificates. Start with common stock characteristics. So first of all, common stock is an equity security. It's issued in the capital markets, which means it's viewed as a source of long-term financing. Because it has greater risk than some other securities, it has higher return potential, particularly when compared to bonds and preferred stock. And in the case of where there's a bankruptcy, the common stockholder has limited liability. The most you could lose as a common stockholder is whatever you spent to make your common stock investment. Finally, common stockholders do have voting rights for the board of directors, and they can also vote to make changes to the company's charter. Preferred stockholders do not have that. For more on differences with preferred stock, please see my video on preferred stock. Okay, so let's talk a little bit about liquidation. And what I mean by that is that in a bankruptcy scenario, which is a scenario where the company may have difficulty paying its bills, the company's assets are sold, and cash from those asset sales is used to pay out creditors in a certain order. And this is the order in the United States. So your accounts payable creditors are paid first. Those people are the ones who provided inventory or finished goods to the company for it to sell. So they get paid first. If there's anything left after the accounts payable creditors are paid out, then it goes to the secured bondholders, then the unsecured bondholders, and then the subordinated bondholders. In the unlikely event there's any cash left after all of those folks have been paid, then it goes to preferred stockholders, and then finally, common stockholders. So common stockholders take the most risk. Notice they are last in line to receive anything in a bankruptcy scenario. Since they are taking on the most risk, you would expect that they would anticipate having the highest returns because risk needs to match returns. Okay, so companies who are generating positive free cash flow have some options. Number one, the company generating positive free cash flow could decide to reinvest that cash flow back in the business. They could decide that they're going to open a new plant, buy another company, spend more money on research and development, spend more money on marketing, pay bonuses to employees, etc. Another option they have if they're generating significant, consistent free cash flow is to save it, right, for a future time period. And then finally, the third option they have is to take that free cash flow and give some or all of it to its owners to reward them for investing in the company. If it does this last option, those are called dividends. So dividends are simply cash that is paid by the company to its shareholders. The company does not have to declare and pay dividends. That is a voluntary action. They are not legally obligated to do that. And if they do decide to declare and pay dividends, they can do so at any time. In the United States, most companies who declare and pay dividends do so quarterly. Dividends can also be canceled at any time. So again, they are not legal obligations of the company. This is something that is voluntarily paid to the company's owners, the stockholders. So a couple of dividend nuances. If a company's board approves a dividend, it usually wants to maintain the dividend and steadily increase it over time. However, it's not a perfect world, so sometimes there are stress periods, and during those times, if the company needs more cash to operate, it may decide to suspend or cancel altogether its dividend. Of course, shareholders aren't normally too happy when that happens. Number one, it means that the company could be approaching a period of distress. Number two, some shareholders may have specifically invested in the company, anticipating a return that included the dividends. If the dividends are no longer being paid, that will negatively impact their return. Okay, so in 2020, when there was a global pandemic, that global pandemic really accelerated in the United States in the first quarter of 2020. And there were a number of companies who suspended their dividends or in some cases canceled them outright. And as you can see from this chart, those companies span the gamut. So we had companies in the travel industry, such as Delta, Carnival, Sabre, and Marriott. You had companies in the automotive industry suspend their dividends, like Ford. Companies in the retail industry, such as Macy's, Nordstrom, and Gap. Companies in the food industry, such as Darden, which owns a bunch of restaurants, including Olive Garden and Capital Grille and Red Lobster. And then you even had companies who do materials, like Freeport-McMoRan, a copper and gold company, and Occidental Petroleum. As 2020 went on and the coronavirus pandemic dragged on, more companies suspended their dividends. So in the first half of 2020, in addition to the ones already mentioned, Goodyear, Wells Fargo, Estee Lauder, and Las Vegas Sands are some of the companies that joined that list. So now let's talk about calculating the value of common stock, particularly dividend-paying common stock. All we need to do is look at the expected future free cash flows from that common stock. If it's a dividend-paying common stock, it would be the dividends and their expected growth, and present value that back. So here's an example where I've got a company paying dividends, and the dividends are expected to grow 5% annually. We can calculate the present value of each one of these dividends and then add that together. This would be an example of a growing perpetuity, because we're assuming that the dividends are going to continue to grow into infinity at a constant rate. Okay, so when we're valuing common stock, as I said, we're going to take the present value of expected future free cash flows. So for a dividend-paying common stock, we'll focus on the dividends. So if I'm standing here today, to estimate the value of a common stock today, I look at the dividend that I'm expecting in the next year, divided by the required rate of return minus the expected growth rate. And this equation is called the Gordon dividend growth model equation. Now, there are a couple of big assumptions with this equation. Number one, it assumes that the company is paying dividends. If they're not paying dividends, you can't use this equation. Number two, it assumes that the dividends grow at a constant rate into perpetuity. If it's not a constant dividend growth rate, you can't use this equation. A non-constant dividend growth rate would be, for example, if a company is expected to grow at a 30% rate in 1 year, 20% for 2 years, and then 55% in years 3 going forward. That is a non-constant dividend growth rate. And many companies, particularly those who are relatively young, have that type of profile. This equation also assumes that the required rate of return is greater than the growth rate. If that is not true, you cannot use this equation. Okay, so now let's look at an example. And in each one of these examples that I'm going to do, I used real companies, but that's the only thing that's real. I made up all numbers and all growth rates and all required returns. Okay, so these are not real numbers. So assume Apple Corporation intends to pay a $1 dividend per share next year. You expect the dividend to increase by 5% annually thereafter. You're going to further assume that your required rate of return for Apple stock is 10%, and Apple stock is currently trading at $10 a share. So the question is, what should be the value of Apple's common stock? Let's take a look. Okay, so we're going to use the dividend growth model here. Again, the dividend in year one divided by the required rate of return minus the growth rate. So the dividend is expected to be $1. So that's the dividend for next year, divided by the required rate of return of 10% minus the expected growth rate of 5% equals $20. So in this scenario, you have calculated the intrinsic value of Apple stock should be $20, given the parameters of required rate of return and growth. So now the question is, if Apple stock is trading at $10 per share, should you buy it if you've calculated it has an intrinsic value of $20 a share? And the answer is yes, because you believe that the stock should be worth $20 a share, and for whatever reason, the market doesn't view it that way, and it's only trading at $10 a share. Perhaps the market is assuming a different required rate of return and or a different growth rate. Whatever the reason, there's a difference of opinion here, and if you believe that you are right, then the market is undervaluing this stock, and you would be interested in buying it, assuming that the market would eventually come around to your point of view. Okay, let's look at another example. So we have Target Corp, and we're going to pretend that Target paid a dividend of $2.64 per share last year. You expect the dividend to increase by 3.5% per year annually thereafter, and your required rate of return for Target stock is 7.8%. So what should be the value of Target's common stock with these parameters? Let's take a look at this. Again, we're going to use our Gordon growth model. So last year's dividend was $2.64. If I'm standing here today, I need to project the next dividend. That's what's used in the equation. So to do that, you can take $2.64, you can multiply it by 3.5%, and then add that to $2.64. That would be your numerator. That's how you find the dividend for the next period. The other way of doing that is to add 1 to the growth rate of 3.5%, and then multiply that by 2.64 dividend. Okay, so either way, that's your numerator. Your denominator is still the required rate of return, 0.078, minus the expected growth rate of 0.035. So when you work the math out, you come to an intrinsic value of Target stock standing here today of $63.54. If Target's common stock is trading at $96.01, are you interested in buying it? Well, you have evaluated Target stock, and you have determined, based on your expectations around the dividend growth rate and your required return for this investment, that Target stock is worth $63.54. The market is probably using a different required rate of return and or growth rate because the market is valuing the stock at $96.01. So if you only think the stock is worth $63.54, you are not interested in buying it at $96.01. In fact, you would say this stock is overvalued by the market. Okay, third example. Let's assume that Kohl's Corporation paid a dividend of $1.13 yesterday. How much will their dividend be in year 8 if you expect a growth rate of 4.5%? To find future dividends, we take the dividend in time 0 times 1 plus the growth rate raised to whatever the time period is you're looking for. So to find the dividends in year 8, take $1.13 times 1 plus the growth rate of 0.045 raised to the 8. And you will get a dividend in year 8 of $1.61. So standing here today, we anticipate that in year 8, Kohl's will pay a dividend of $1.61, assuming a constant growth rate of 4.5%. So, a little wrinkle to this question is, what do you expect Kohl's Corporation stock price to be in year 7 if you have a required rate of return of 8.8%? So remember, the Gordon dividend discount model says, if I'm standing here today, I take the next dividend divided by the required rate of return minus G. So when we did this equation on the prior slide, we calculated that the dividend in year 8 was supposed to be $1.61. We divide that by the required rate of return, 8.8%, minus the growth rate of 4.5%. So we have determined that the value of Kohl's stock in year 7 should be $37.44. Notice how I'm standing in year 7. In the equation, I am using the dividend expected in year 8, and that's the annual dividend. Okay. So that's the answer to the question. In year 7, based on these parameters, we expect Kohl Corporation stock price to be $37.44. Okay, let's look at Lyft. And again, this is all made up. Lyft Corporation doesn't currently pay dividends. However, you expect it to start paying a dividend of 46 cents a share in year 7, with it growing by 4.2% annually thereafter. If your required rate of return for Lyft stock is 9.5%, what is the intrinsic value of Lyft stock today? Okay, let's take a look at how we do this. So remember, if I'm standing in year 6, I need to use the next period's dividend, which we've indicated we expect to be 46 cents a share. Then I'm just going to divide that by my required rate of return, 0.095, minus my constant growth rate of 0.042. And so I calculate that I expect the value of Lyft stock in year 6 to be $8.68. Now, the question asked, what is the intrinsic value of Lyft stock today, not in year 6? So all I need to do is use my time value of money equation and say, well, the future value of what I anticipate Lyft stock to be in year 6 is $8.68. Divide that by 1 plus the interest rate, which is the required rate of return of 9.5%, raised to the 6th power, because that's 6 years from now. And when I discount it back, the value of Lyft stock today should be $5.04. Okay, so now let's look at Stillwell Company. Stillwell paid a $2.50 dividend last year, and the company is growing at about 7% annually. Should you buy the stock, which is trading at $49, if your required rate of return for Stillwell is 12%? Still using that same dividend discount model, I'm going to take what I anticipate the dividend to be for the next period. So that is last year's dividend times 1 plus a 7% growth rate. That's the numerator. My denominator is the 12% required rate of return minus the constant growth rate of 7%. So I have determined that I believe standing here today, Stillwell stock should be valued at $53.50. Notice the stock is trading at $49. So there's a difference of opinion here. The market must be using a different required rate of return or growth rate than what I am. So the market has anticipated that Stillwell stock should be valued at $49, but you say, no, it's actually worth $53.50. So if you say, should you buy the stock? The answer is yes. The market is undervaluing the stock in your opinion, based on these parameters. Okay, let's look at the same example, but let's approach it differently. So here I took the equation of the dividend growth model and I reworked it a little bit, solving for the expected rate of return. Okay, so we take the dividend in year 1 That's the $2.50 times 1 plus the constant growth rate of 7%, divided by the stock price today, which is $49, and then add the growth rate of 7%. And when we do that, we get an expected return of 12.5%. So what that means is if you buy Stillwell stock today at $49, you are anticipating a return of 12.5%. If your required rate of return on this security is 12%, and it's offering a return in the market of 12.5%, yes, you would be interested in buying the stock. So you get the same answer as how we did it previously. Okay, that's all I have on common stock. Thank you for spending time with me. Until next time, this is your finance-ista, Cynthia Bush. I'm signing off. Don't forget to subscribe to my YouTube channel.